Aloha, everybody. Welcome to the Bubbles Stock Market Show. It is Tuesday, October 14th, 7:58 a.m. Eastern Standard Time. The stock market will open in about an hour and a half. We do have the futures market open. Of course, we have the dollar up here, gold, silver, Bitcoin, oil, all four of these stock market. And this, the volatility of the stock market. Let's take a quick look at these bottom four. Kind of similar, right? When you compare this one to these four, these are more similar with each other than they are with this one. And so we had on Friday, we had this big pullback. On Monday, we had an up day that sort of from the bottom of this close gapped up here, rallied all the way up here into this resistance area, and then this trading day, the following 14th for the futures, you see it sold off. Now it's basically went below where this candle opened and now rallied back up here. So we're kind of getting stuck in this resistance area, support resistance area right in here. Kind of the same thing for the NASDAQ, sort of the same thing for the Dow, and sort of the same thing for the Russell, which is pretty common for these four to have some similarities of look. And then the futures of the VIX sold off yesterday and then really spiked up today. So that's what we're currently looking at the moment. Let's take a look at some different type of indicators. Look at this one, the MMRI. So it came down just a little bit. Let's see, it was last reported on the 10th. So at least right here we have a bit of a lag. So today's the 14th on the 10th. But overall, I can kind of remember when it was the MMRI was up here. So over since like June, August, July, somewhere in there. Overall, the MMRI has kind of been coming down. So you see the 10-year yield is right a little bit over 4. Dixie at a little bit under a little bit under $1. Yeah, it's pretty accurate. So when I see this moving more towards a lower number than a higher number, while the stock market is on kind of shaky grounds, then that gives me a little different of an indication than if the stock market is on shaky grounds and this number is increasing. So it might be a little stable. Let's take a look at this, the Buffett indicator, which this one is more about giving you an idea of how much actual risk is the stock market is facing. Now, it's always facing a certain amount of risk, but as this number gets higher, the risk is higher, and it has a lot to do with the dollar and the 10-year yield, where money would be flowing. So overall risk indicator. The Buffett indicator, which you could look up any of these yourself. Here's the URL. Here's the URL. The Buffett indicator is a bit more on giving you an idea of it is the stock market in general a good price compared to other investments. And when this is close to or over 100, at 100, it's not the best deal around. So in a way, by the Buffett indicator, the stock market is a little bit pricey. Unemployment still has not been updated over here. We're still lagging at August 25th at 4.3. That's the last data point over here, August 25th. But it says it's been updated September 5th. Looks like unemployment, as per these numbers, it's not moving right now. It hasn't moved. Put the call ratio I need to get better at reading the put to call ratio, finding a good place to read it. I'm not exactly sure how to read this, so I will put some more work into that. I tried looking up the put to call ratio on the Chicago Board of Option Exchange. Didn't have the easiest time finding it there either, but I will find a easy place for us to monitor the put to call ratio. Is it this one I'm looking for here? Is it this one? Not sure, but we have days to expiration. Here's one. Let's take a look at 30 days. Where is the number that I'm looking for? I will put more research into that and see how we can use this information to help guide us. But it can be. I know that there's a way to extract some really good value out of the put to call ratio. It's just something that I will have to gain a little more clarity on and figure out a way to deliver some more value to you, my friend. So we'll we'll take a that's all we're going to look at for the kind of different indicators off from a chart for the moment. So we looked at our overall charts. We see the dollar is pushing up on the top of this range. Gold made a new high again. Um, uh, gold futures, silver futures made a new high. Bitcoin futures still pulling back. Crude oil futures made a new low. And we talked about what's going on in the stock market. Here, we last night we looked at how the FANG stocks ended the day. Let's take a quick review through those. So Apple kind of repairing the damage that was done from Friday, but overall in an uptrend. Same thing as far as repairing the damage. The big red candle here for Amazon, and now Amazon had Monday had a green candle, but you see it's trading in. If we were to split the body of this candle or the total length of the candle, including the wicks, if we were to split it into a 50-50 increment, this price action is in the bottom half of this big drop here. And it's probably looks like it's gonna run into some resistance area in this 222 to whatever this is down here, 218, 216, and we see that kind of happening here in the last month. Amazon, um, Microsoft, bit of the same thing, but not as big of a drop on Friday. And it's a little over in the 50. I mean, it's close to the 50%, but it seems to be a little over 50%. We are going to be dealing with these moving averages turning over here. It's on top of the 200-day moving average. But overall, you see it's kind of in the sideways range. Until it really breaks out of the sideways range, it's in a sideways range. NVIDIA, which before this day, I had it in a basically more of an uptrend with a quick look from left to right. But with this down day, it really, with a quick look from left to right in a 3 month period, it's really kind of got us in a more of a sideways range. Granted, at the top, pushing the top of the sideways range right now is around 190. In this 190 area, maybe it'll continue a strong bull trend, but at the moment, we're waiting to see on that. Netflix going sideways. On Friday, it really pushed up here, but sold off. It was continuing this little trend. It had a gap up in a couple days, these up days, and then right around this one or the 1240 area hit resistance. You see the the result of that resistance pushing prices down here, but overall sideways. Meta sideways, same thing. Not as extreme of a drop as Amazon, but the same thing. Big drop, gapped up just a little bit. Where did it gap up to? Like right here, sold off. It's trading in the bottom, kind of in the bottom 50% of this candle, and we have these moving averages that are maybe giving it a little bit of a hassle. Google still looking strong, right under this moving average. Seems like it's getting a little bit of resistance from that, but maybe it'll end up breaking up through that. Now we're back to Apple. So, quick review of those. And oh, here's maybe the most important thing. Out of 7 mag stocks, 7 of them, 5 out of 7 are basically going sideways. One, two, three, four, five. 5 out of 7 going sideways. So don't be shocked if you see a lot of sideways choppy action at the moment. Let's look at this after hours. You got this is an hourly, one day, 1 hour. So here's the one day. The black area is the trading day from Monday. Now this area here is the time the instruments are trading between Monday and the opening of Tuesday. So we see the S&P 500 via the SPY is kind of sold off from where it closed yesterday, sold off. So we're right around in this area. The VIX jumped up in after hours trading, hit as high as almost 23. We're still trading in this elevated range here. What else might be? I have a position on this ticker now, working on adding the second leg of to complete a short strangle. Right now, I'm just short on calls at the moment. And this short strangles, depending on how you do them, can be more or less risky. For example, um, right now, like this stock, see is trading right around 914. So if you short a strangle on this, let's just say one strangle, that means you're going to sell a put option lower than the price that it's at. And remember that put option obligates you to buy 100 shares. So if you sell a put option down here and you don't have the money to cover buying cover buying 100 shares at $880, if you don't have that money, then you are selling a naked call, a naked put, right? 800, if you make a promise to buy 100 shares at the strike price down here at 880, which this is not the strike price that I use. I'm just randomly grabbing that. 880 times 100 shares. Really, you need to have a surplus of $88,000 in your account in order not to be naked on one side. Now, on the other side, if you were to make an actual short strangle, you sell a put option below the price the stock is trading at, and you sell a call option above the price that the stock is trading at. So let's say you you sold a put option around the 960, because we can see that number here. Then not only are you obligating yourself to buy 100 shares at $880, but you're also obligating yourself to sell 100 shares at $960. What if you don't have any money or any shares? Then you're rolling the dice. You are definitely taking on more risk if you do that, which would be called a naked strangle. Be naked on each side, and whatever the professors in the ivory towers are going to agree upon some names. Like, who kind of cares? Like, the reality is, regardless of what the name is, the risk profile is the same. You have a lot of risk to the upside, you have a lot of risk to the downside. So you better be pretty good at managing and setting and reading charts and setting up stuff. However, there's another way to short strangles without having that much risk. Now, let's say if you had $200,000 cash in your account, and you also had 100 shares of now that you happen to buy at $920 a share. So you have 100 shares. So when you sell this call to when you sell the call, when you short the call at 960, which is basically saying that you will sell 100 shares at $960. generally speaking, if it goes over $960 upon expiration. But it could be any time before that, even if the price is under it. It's not what happens as often though. But the big picture, the big point here is that you have the collateral, you have the 100 shares, and you bought them at a lower price than you're obligating to sell them for. So even if you had to sell them, you'd be selling them for a profit, and you got the premium received from that. Now, on the flip side, we are pretending you have $200,000 in your account. So that means you have enough money to buy the shares that you're promising to buy at the price you're promising to buy at. So in that case, you have basically a covered short strangle. So it's in a way, it's not so much the actual strategy, unless you're saying the strategy is a naked strangle. But as far as just like short strangles in and of themselves, they're not necessarily risky. It depends on how you set things up. And let's say if you are someone with like a 5,000, a $1,000 account, well, you might not be able to do things as easily here as far as setting up a covered strangle type of situation, unless you move with stocks that are much less expensive, which is, I reorganized my anything tab, but not my anything after hours. So because of the way the option chains work and just the whole market works, like sometimes it's good to build a position in, let's say, FCX, which is significantly less expensive than ServiceNow. So trading around a little less than $43. It would be a lot easier to build a position of 100 shares when the share price is around 43 than it is when it's almost $1,000 stock. So, with maybe around $4,000, maybe you can get away for a little bit less than $5,000. You could have 100 shares. And a short strangle is just a combination of shorting a call. So you could sell a covered call and and sell a cash secured put. A cash secured put means you have the money to buy the stock that you're selling the put protection on. And a covered call means you have the shares to sell at the price, right? You have the collateral, you have the shares. That's what you're promising, is selling someone shares. So you have those shares. Easier to do. So let's say if you had a total of like $10,000, right? And then out of that $10,000, you accumulated 100 shares, either with one purchase or several purchases. However, it doesn't matter. Let's say you purchased 100 shares for an average share price of around $41, 41.50, somewhere in there, right? Somewhere 41.75, but let's say less than 42. Right? So you have a little bit of profit built in here, and you have $10,000, right? So you still have an extra. You have money sitting there as a cushion. So you could sell a promise to buy FCX at 40. I'm not saying you should choose this number. I'm just randomly choosing a number because it shows it right here and has this line. Right? And we see it drop down to about $40.84 with our this moving average under this one. It still technically could fail and go back down. But let's say you don't think it's going to, or you would be happy to buy it at $40. You think $40 is a good deal. You want to buy it at 40. You're hoping to buy it at 40. You're hoping it goes back down. Great. Okay, so that's a good stance to be in relationship to this number of 40 if you're going to be selling a cash secured put option. So if you have the money you have $5,000, a little more than $5,000 of cash in your account with no other obligations, then you could make a promise to sell a put option at 40 or whatever strike you want, take in some premium. Now, of course, there's a discussion for how many days to expiration. And you could also, because you have 100 shares that you purchased a little bit below 42, you could sell like any number above 42, and you'd be in a real win-win situation. If you had to sell the shares, you'd be selling at a profit, and you took in the premium, and you're taking in premium from selling the put. which you're in a good position because you have the money to fulfill your legal obligation and you like the price you're going to buy it at. So that is a way that uh, you could incorporate short strangles, but with much less risk involved with them. Another thing to do, where is Coca-Cola and where is MO? Okay, so where are these at? These overall, let's take a bigger look at Coca-Cola and MO. Here, at, let's look at this, KO. So this is FinViz, it's free, as long as you have some, you can pay to have the ads removed, but otherwise there'll be some ads if you have it free. So we're looking at Coca-Cola. Is it profitable? Let's see here. Profit margin, almost 26% profit margin. That's pretty good. Gross margin, a little bit over 60%. So it's a profitable company. What is the enterprise value to EBITDA? Enterprise value to EBITDA, if this was a little about half, it'd be a bit more exciting, but this is not the worst. What's the PEG? PEG is a little less than 4, not too exciting. PE ratio is probably getting closer to what we would see. Like I'm taking a look up at some stats like this that I have written down. And when I wrote down Meta had a PE of 26.05. Netflix had a PE of 49.31. Google, just the GOOGL. I'm not sure which shares that is, but excuse me, just the GOOG, the not the L ticker, has a PE ratio of 26.18. And the last time I looked up this, Coca-Cola PE went up just a little bit. Last time I wrote down Coca-Cola PE, it was 23.36. MO, last time I looked and wrote it down, was PE was 12.57. So better deal just on that statistic. And FCX was at 30, PE of 30.74. So you see, looking at the PE, it's kind of in an average right in there, peg high. So Coca-Cola, though, here's the thing to really profitable, raising the dividend every year, at least a little bit for the last 50 years. It's a dividend king. And we see overall the price has been going down, right? I'm I'm kind of thinking anything around 66 or below is good, but I have been short some puts at the $60 strike price. I've been shorting puts on Coca-Cola at $60 strike price basically all 2025. And right now I have some short puts open at the $60 strike price. However, just to pick up some shares, I think anything like once it's below 66, it's worth starting to look. Doesn't MO, let's take a look at MO real quick. Is it profitable? It is. Look at this. Profit margin of almost a little over 43%. You know, you could say getting closer to 50%. It's closer to 50% than it is to 25%. Gross margin, a little over 70%. It's pretty amazing. And the PE ratio, really, really low. PEG ratio, lower than Coca-Cola. Still a little higher than where we would really want to see it, like closer to 1. Enterprise value to EBITDA, you know, look at this. It's close to 10. It is close to 10. It's closer to 10 than Coca-Cola is. This might be a better bargain just based on dividends and earnings to share price, la da da da. This might be a better deal at the moment. And same thing, been raising the dividend. It does have a higher dividend, and but it's also dividend king. So these two, but what would be maybe a good price? I think definitely if I was looking to just start building a position kind of one share at a time, I might be buying below 64. Like if it's gonna, because right here it tests the 64, it went a little bit below this moving average, the 50-day moving average right here, touch that, boom, shot back up. And over here it's kind of testing that, but if you can get around the $64 price or anything below, it might be even a better deal. But overall, it seems to be a pretty good deal right now. If you don't have anything in your anything in your portfolio, then that wouldn't necessarily be the worst thing to do. Pick up some shares there. So if you're part of the one share gang and you're looking to pick up some shares, those are two stocks to potentially look at. We need to look at FCX, but we're running out of time. I want to get this wrapped up. The quick opening edition of the Bubbles stock market show. So what can we be expecting today? Oh, I forgot to look at this. What can we be expecting today? Here are the events specifically for today. Are these going to be some big monumental market moving events? Maybe this one. Uh, Federal Reserve Chair Jerome Powell speech. Maybe that's going to be getting us some movement. Do we have any other big wigs talking? It's a lot of data coming out here. You can find this on Thinkorswim under the markets tab, which is the same tab with monitor, trade, analyze, scan, and then markets. And then after markets, you would look under calendar, and you can control a variety of information that you want to see here. Earnings. As you can see, I just have Econo Day event. What we got for Friday? So I could probably be a lot better at paying attention to these events that drive the market, because they do drive the market some to a degree. To what degree it is. Sometimes it's just wiggles, gyrations in news. Sometimes it can be big gyrations in news, but sometimes it's not anything really meaningful on the upside or a downside, because when news events are pre-known that they're going to be announced, there's some amount of built-in forecasting into the stock market. I don't know how much, but this this has been on the calendar since, like, I don't know when, but last week when I was looking, it was already here. So this is not a surprise to anyone, other than maybe like you or I. But no big movers in the stock market are shocked that Jerome Powell is going to be speaking today on October 14th. Everybody's aware of that. It's easy information you can get. So is it going to make the market go up? Is it going to make the market go down? It's already this question that's kind of being built into the stock market. So you can't really say it's a black swan unless Jerome Powell comes out and does something, super, super crazy, unexpected, brings out the bozo bucket bonanza and just kind of goes Looney Tunes and everybody can tell. Like, that would make it turn into some sort of black swan. But I don't know. My definition of black swan is not going to be hit by probably something expected, some expected news event. So with that, let's wrap this up. If I can get this uploaded, that's not what I wanted. Boom, there we go. Stock market show Bubbles. Aloha.